Energy did underperform, by 20 points by 20 points last year for the S&P. It was only up 2%. But our next guest says this will be a better setup. Neil Mehta is an energy analyst at Goldman, joining us ahead of their big conference next week in South Florida. And Neil, I didn't realize it was quite that bad not bad, but it just kind of treaded water. And this was after a couple of strong years. So you think 2025 is going to be strong again?
Yeah, energy cycles tend to last a decade, and we've gone the last 50 years with 2 down cycles and 2 up cycles. We still believe we're at the beginning of a structural upcycle. It began in 2021. We think it'll last the better part of the decade, but with any upcycle, there are periods of pause. 22 and 23 were 2 years of that pause. 24 does feel like it's set up better for a variety of reasons. First of all, the secular element around power demand and the growth that should drive in energy demand, including for natural gas. Second, the valuations look compelling here. We've seen the XLE having pulled back from 97 as its local high post-election to closer to 87, 88 right now, having seen the trough at 83. Our implied valuations would say that should be closer to 100 at fair value. And then ultimately, we still believe that the sector has attractive return of capital opportunities. And in the past, capital stewardship was a problem in terms of how these companies allocated capital. But one of the things that we think we're going to hear next week when we have 850 people converge here down in Florida to talk about energy is that these are much better run companies which have a much higher probability in the future of earning returns in excess of their cost of capital.
Well, it should be 851, Neil. So we go every year to your Energy Clean Tech Utilities Conference. Look for not this year, but look forward to going next year. We do have some guests on for the conference, including you now, so do appreciate that. You're making a compelling case for energy. So why has energy as an investment, what's the technical term, stunk? It's underperformed the S. When all we do is talk about how much power Microsoft and NVIDIA and everybody else is going to need to power all these AI dreams, which is powering the stock market. And yet that power is not, Constellation, Vista, and some others are, but for the most part, it's not generating returns that our audience want.
Yeah, it doesn't feel like a conference without you there, Brian. And I think you've made a great point in that we need to bifurcate the performance of last year. Those related to power in that power ecosystem have done tremendously well, whether those are the independent power producers, many of the regulated utilities, companies in the uranium complex, the nuclear complex, the specialty contractors like the MasTechs and the Quantas of the world. That AI-related power demand basket has performed well, and we think will continue to perform well. What has been left behind is oil. And a lot of that has to do with the fact that there's so much spare capacity in the system. Right now, Saudi is producing 9 million barrels a day. They have the capacity to produce closer to 11. So that in itself is 2 million barrels a day, or 2 years worth of oil demand. And so it's made it harder for people to get excited about the oil side of the equation and the oil complex. That said, I do think that there is going to be a period of time in the investable future where non-OPEC supply is going to be in deficit relative to global oil demand growth. And that looks like it's a 27, 28, 29 story. An oil market is on the precipice. We've just got to work through these 2 years of large projects coming into the equation.
Yeah.
One of the challenges has really been shale and how resilient U.S. supply has been. As Brian, you've written and talked a lot about that. We do see shale maturity on the horizon. I think that's going to be a theme that should propel a better setup for energy as we think about the 5-year horizon.
Neil, I was just going to pile onto that and say, I care about oil when gas prices are high in this country, but nat gas is what it's all about now. In the age of electrification, with the needs that Europe has, the fact that we might now be filling that gap, we're the biggest exporter. They have 5 plants coming online. Dan Yergin says the size of this boom could rival even the impact of the AI chip boom. This is a huge deal for the U.S. So I don't really care about oil anymore.
The place that is very dynamic as we think about the natural resources ecosystem is power. Right now, the demand in the United States is 4.1 trillion kilowatt hours of electricity on an annual basis. That has basically been unchanged for 15 years. If we compound at 2.7%, which is our annual growth expectation, will be over 5 trillion kilowatt hours of demand by early next decade. The challenge is our grid is 50 years old, and we need to invest a lot more. So I would look over the next 5 years for utility capital spend to be up 40%.
Wow.
versus the last 5 years. So there's a tremendous amount of capital that needs to be deployed to get our grid up to speed. Part of the reason we like companies like Quanta Services and small caps like MYR Group, but we have a constructive view on the utilities complex. Utilities are not boring. Utilities are actually one of the most interesting complexes in the broader market.
Totally.